Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Manager, and today we're talking asset location. What world is that? It's kind of weird. See, we spend a lot of time talking about investing, but a lot of the times the best thing I can do as far as helping customers with all of their retirement savings is asset location. See, IRAs, Roth IRAs, they have tax advantages where you don't have to pay capital gains tax like a brokerage account, and one of the ways that we help is by not even investing for customers, right? We do manage our own funds here, of course, and of course, you know, we share that and teach with everybody along the way. But today we're going to talk about asset location and how you might think about this generally. This is not the right way to do it necessarily. Everybody's going to be a little bit different here, but generally, if I have to try to talk to the most of you, this is what I'm going to try to share with you here today. Now, for the sake of our discussion, we are going to call investments tax efficient and tax inefficient. So every type of investment fits into one of those categories. We could argue the difference between them, but that's what we're going to talk about today. So the tax inefficient type investments, we're going to save for our, how am I going to do this today? I'm going to go like this. We're going to go IRA, and anytime I talk about IRA today, this will be like SEP IRA, pre-tax type accounts, right? So this could be even your 401k and things like that. So we're going to say Roth, IRA, and taxable. Think pre-tax when we look at IRAs. All right, tax inefficient type products are going to go in the Roth and the IRA, right? Because we have the tax advantage of not paying the capital gains. We don't have to pay on dividend income and things like this. So what we're going to have here is dividend stocks. I know you guys like your dividend stocks, right? That's going to be a first one we're going to consider for the Roths or the IRA. See, if you put them in the taxable account, you got to pay tax on the dividend in the year that you got the dividend. You most likely have to pay tax on the dividend in the year you got the dividend. Some of them get treated as capital gains, other of them get treated as dividend income or interest income. All right, we're also going to include your active ETFs or mutual funds, right? I'll just leave it with ETFs, or you could say mutual funds as well. These would be ETFs that are more actively managed, that have, they call it high turnover, meaning that they're swapping positions in and out of the ETF more so than others, right? Like an index ETF or something like that. All right, we're also going to want to put our bonds in there. For the most part, we're going to want to put bonds in the tax inefficient investment in the Roth or the IRA, all right? When we say tax efficient investments, those we're going to save for the brokerage account, right? Can you see that? Does that look good? All right, so tax efficient, we're going to say things like index funds, right? I know you like your index funds out there. Anything that replicates index funds, not our active funds, but our index funds. We're going to do our low yielding stocks, right? There we go. Low yielding stocks. Sorry, I don't know. I can't write today. I'm going to stop. All right, and what was the other? Muni bonds, right? Things like that. Okay, so if you can read that, that's where we stand right now. Now, that's just a general sort of mix of where you want to put these different investments. You don't necessarily just want to say, I have a Roth IRA and therefore I'm going to put an index fund in there because that's just what I want to do. That's what I've been taught. Think about it. Think about the different account types that you have. Now, depending on your income and capital gains tax and everything, you may want to put you may want to think of it like this. If you're in growth mode, like you're a growth investor, you're younger, in your 30s, or you're trying to be actively aggressive here, then you might want to think about going this direction with your growth stocks, right? Yeah, I'm sorry. I can't tell if it looks good. Yeah, okay. So we're going to go like this. We'll just draw a line and we'll say like this. Your highest growth stocks may want to go in this order. I didn't say the most volatile. I didn't say the Apples and Teslas. I said your highest growth stocks, right? Why is that? Because here we never pay tax. The growth is never taxed throughout. So obviously we want as much growth as possible. We're avoiding tax. We're paying tax later over here, right? So that's second best or whatever. Over here, we've got your capital gains tax. Depending on your income and where you land, that could be a sizable chunk of money. Not for everybody, because the capital gains rates go 0, 15, and 20 if you're going with things like that. Also, this doesn't come first because what happens with traditional IRAs? You got RMDs, right? So we don't want to have a sizable group, a sizable IRA, and then have to take RMDs, required minimum distributions. If this account gets too big relative to our others, and we have to take money out of here, that required minimum distribution could be quite large, right? Okay. What else do we want to include? Hey, what about your volatile stocks? I said a second ago that we want our growth stocks to go in this order. What about your most volatile stocks? Everybody gets this wrong. Everybody gets this wrong. Your growth stocks do not automatically go in the tax advantaged vehicles. They go over there, right? Especially as you get to have a lot of money here or here. Let's say this is your 401k, you got a Roth IRA, your taxable account. Where do the volatile stocks go? Those that you're swinging for the fences, your Teslas out there, your DocuSigns, the stocks that are all over the place. You're taking a shot, right? Maybe Carnival Cruise, been a little bit more volatile. Boeing, right? Things like that. They go in the taxable account. Why do they go in the taxable account? You say, if it grows, I'm going to owe the capital gains. Yeah, but what about the other side? What about tax loss harvesting, right? You've got a stock that's wiggling all over the place, or a group of stocks that are wiggling all over the place. They're doing this constantly, right? Well, that could help you. There could be a chance to take a tax loss where you can write that off on your taxes, up to $3,000 at the moment for an individual, right? And you can't get that if you have a steady growing dividend stock or some real slow poke type stock like a Ford or something like that, right? Also, so think about that for the taxable account. What happens if you have too much in the taxable account? And you say, well, I don't need all that tax loss stuff. Where does it go after that? Goes to the Roth IRA, right? You don't put it in the pre-tax. You go with the Roth IRA, Roth 401k if you have that option to you. So it's going to be taxable first until you have enough volatility to write off those losses if you want, do a little tax loss harvesting. Then you go to the Roth, right? Oh, I'm sorry, I said it wrong. No, I said it wrong. I went backwards there. It goes this way. Stop it. No, you didn't see that, right? So we're going to go taxable, then we're going to go IRA pre-tax, then we're going to go Roth. It goes backwards. I said it backwards. Oh my God, it's Friday. Let's wrap this thing up. This is how your volatile stocks are going to go, right? Gosh, I should start over. I'm not going to start over. Taxable account, IRA, then the Roth if you have to. Why is that? We've got the stocks over here, right? We know tax loss harvesting, great. What happens with volatility in the IRA? When they're down, your group of stocks are down, we can pick those up and put them in the Roth at a lower value. The IRS only sees the value of the conversion. I'm talking about a Roth conversion here. So volatile stocks over here to get a tax advantage if you need to harvest some losses. And then over here, when there's a move lower because of, I don't know, a virus, right? The value is lower. You might say, I'm going to take this bucket of stocks and I'm just going to put them over here in the Roth. I'm going to pay taxes on that amount, but that amount is much lower, 30% lower with the virus, than it was up here. The IRS is going to see this value, so you can convert to a Roth. You know what's going to happen with those volatile stocks. They're just going to go back up and down and up and up and down again, right? But when the value recovers to where it was, you don't pay tax on that. The IRS won't even see it. They don't care, right? So we got to think in terms of your dollars as a whole. Don't just look at investments and say, well, that's a stable, steady investment. All right, if that is attractive to you, then which account does it go in? And now hopefully you have a general, very general understanding of how that works. I hope that helped you in some way. I'll stop talking for here and maybe we'll come back to this at some point and sort of visit individual positions. What counts as a low yielding dividend stock that maybe it's low dividend, high volatility? What do you do then? Anyways, hope you enjoyed that. Be sure to think about the investments in your accounts, not just the accounts themselves, and how they relate to your nest egg as a whole. That's all I got for you today. Enjoy the rest of your day and your weekend. We will talk to you very soon. We'll be back next week to do this all over again. I appreciate you watching. Hit the subscribe button. Help us out. Let me know if you like it, or if you were mad that I messed that thing up a minute ago. You can, I guess.